I'll type करके देखो पहले।
Okay, sir.
Hello friends, my name is Dr. Sunjeev Batra. I have been retired from the income tax department. At the time of retirement, I was working as an income tax officer. This is my first class, and in this class, I am going to take up penalty and prosecutions. In the past, and most of the time, you have seen that number of YouTube channels also about the income tax, wherein they start the classes from the source of income. There are 5 sources of income in the income tax: salary, income from house property, capital gain, income from business and profession, and income from other sources. But in my view, it is not way to start the income tax classes. I am taking the classes where the students find difficulty in understanding the provisions and concepts. So I have divided the whole Income Tax Act into different topics, and that each topic will take up at least 3 to 4 classes. Because in one topic, in one class, if I take up more than 2 hours or 3 hours, you will get humdrum or bored. So in my view, it will be better if we divide that whole topic into 3 to 4 classes. Penalty and prosecution class is quite lengthy, and if I take up the whole topic in one class, it will last in more than 3 hours. So it will be better to understand in a simple way. I will take up the class in 3 to 4 classes. At the outset, I would like to tell you about something about the penalty. From the assessment year 2017-18, there was a sea change in the penalty sections, penalty provisions. Prior to that, till assessment year 2016-17, there was a prominent sections like 271 within bracket 1 within bracket C. It was about the penalty for concealment or furnish inaccurate particulars of income. Penalty was imposed, and there were number of conflicting judicial judgments about this penalty, and the most of the time department lost in appeal. So government decided to change these penalty provisions and bring new provisions, new sections, so that it will be easier for the department as well for the assessee to understand the penalty, what is penalty and what is prosecution, and on what circumstances the penalty will be imposed, shall be imposed, and prosecution shall be initiated. New sections have been brought in like 270 capital A, 271 AAC, 272 A1D, like that. We will take up sections back to back, one by one, and in my first class, I am going to start with section 270 capital A. I would like to mention here that prior to assessment 2017-18, the penalty under section 270(11)(c), it is still existing because the cases where the cases are reopened under section 147 or in another sections due to search and seizure operations, the same provisions are applicable. So we cannot overrule that this provision has been outdated or will no longer be needed. It was stood on the two limbs: penalty for concealment and penalty for furnishing inaccurate particulars of income. Most of the time, penalty was strike off or deleted by the appellate authorities due to technical reasons. Most of the time, the technical reason was that it was strike off or deleted by the appellate authorities because at the time of initiation of penalty, the limb was not strike off. Under which limb the penalty is to be imposed was not strike off by the assessing officer. If the penalty relates to concealment of income, it becomes mandatory for the assessing officer to tick that point that it relates to penalty for concealment, or if it relates to penalty for furnishing inaccurate particulars of income, at that time it becomes mandatory for the assessing officer to tick that point. But in most cases the point was not indicated and the penalty was deleted by the appellate authorities. So it was become the routine in number of cases where the technical point, there was glitches in the technical point, so government decided to bring new provisions. In this class, I am going to start with penalty provision under section 270 capital. This is the most prominent section in these days because it is quite difficult to understand the provisions of these sections. Moreover, I have also seen that from my experience that the intricacy in the provisions brings difficulty to understand the provisions in a simple way. So I will try to explain, I will try to elucidate the provisions in a simple manner with examples by making PowerPoint presentation also, so that it will be easier to understand, it will become easier for you to understand the provisions. Slowly I will start the class taking up the first section, that is 270 capital A. I would like to mention here that before starting this class that I will explain the provision first and simultaneously PowerPoint presentation wherein some examples have been quoted by me, and I will explain the examples so that you can understand in a proper manner what provision stipulates. So I am going to start this penalty section 270 capital A. This section, there are 12 subsections in this section 270 capital A, and it tells us about the penalty for underreporting and misreporting of income, where what is underreporting and what is misreporting I will explain in a later portion. But I would like to mention that it starts with first section. There are 12 subsections. First section tells us about that who can impose the penalty. Prior to assessment year 2017-18, there was a penalty, most prominent penalty was 271 within bracket 1 within bracket C, as I have indicated earlier, as mentioned earlier, and it was imposed by the assessing officer only. But in this section, the penalty can be imposed by assessing officer, joint commissioner of income tax, commissioner of income tax appeal, commissioner of income tax, principal commissioner of income tax. And under what circumstances they can impose the penalty? They can impose the penalty while completing the proceeding under the Act. But what are the proceedings? This is to be seen. Assessing officer can initiate the penalty under this section while completing the assessment under section 143.3, 144.4, that is a best judgment assessment, 147, when we reopen the assessment. And what about the Joint Commissioner Appeals and CAT appeals? They can also impose the penalty, initiate the penalty and impose the penalty under these sections when they decide the appeal and makes enhancement in the income of the assessee as underreported income and misreporting of income, which is in consequences of underreporting of income. They can also impose the penalty, and it becomes mandate for them to impose the penalty. It will not be imposed by the assessing officer. They have not to forward the same to the assessing officer that they will impose the penalty. Instead, the penalty will be imposed by the Joint Commission Appeals or the CAT appeals themselves. and which is under section when they decide the appeal under section 250 of the Income Tax Act. What about the PCIT or CIT? They can also impose the penalty when they decide the appeal, when they decide the review petition of the SSC under section 263 of the Act. That is the revision petition filed by the SSC. Revision petition initiated by the department, sorry. And in that case, whenever they make the addition, whenever they add the income, they can impose the penalty under section 263 of the Income Tax Act. So these are the authorities which are mandated by the Act to impose the penalty whenever they find the income is underreporting. The next section about that is subsection 2, and it states about who is the person on whom the penalty can be imposed. The persons, they have defined the provision defined the persons who can in whose cases the penalty can be imposed at the time of underreporting of income. Whenever the person has a assessed income, whenever the person has filing the return of income and assessed income is greater than the income determined under section 143(1)(a). And I would like to mention here that it is pertinent to point out here that income determined under section 143(1)(a), the difference between the two, assessed income is greater than the income determined. For example, when the income assessed, let's take an example. When the income assessed is 10 lakh and the income determined under section 143(1)(a), even some adjustment have been made at the time of income determined under section 143(1)(a. That amount shall be definitely included while determining the income under section 143(1)(a), but that is not the underreporting of income. That says that difference between the assessed income and minus the income determined under section 143(1)(a) shall be the underreporting of income. And I am going to take up the example. Let's take the figure of 10 lakhs as assessed income, and income determined under section 143(1)(a) is 8 lakhs. The difference between the two is 2 lakhs. That is the underreporting of income. So the person who is having that income, the person who is having that income, that will be called underreporting of income. The next subsection, the next clause under this section tells us about when the assessee is not filing the return of income. In that case, what happened? In that case, the provision provides that when the assessed income is greater than the maximum amount not chargeable to tax, in that case, the difference between the two, it means that difference between the two, assessed income and the maximum amount not chargeable to tax, because assessee has not filed the return of income, or assessee has filed the return of income in response to notice under section 148, and when the 148 is issued by the department, when the case is to be reopened, and when the case is reopened, when it comes notice to the department that income has escaped from assessment in the preceding years and assessee has not declared it in his return of income, in that case the cases are reopened and notice under section 148 is issued. So whenever there is a circumstances that assessee has not furnished his return of income but furnished his return of income first time in response to notice under section 148, in that case the difference between the assessed income and the maximum amount not chargeable tax in the case of individual HUF like that, the maximum amount not chargeable tax is 2.5 lakhs. If you are not senior citizen, if you are senior citizen, then it is 3 lakhs. So that amount is to be subtracted or reduced from the assessed income while determining the underreporting of income. The third subclause tells us about when the income is reassessed. And reassessed income, when the income is reassessed, when the case is reopened under section 147. And when the reassessed income is greater than the last assessed income or last reassessed income, then the difference between the two is also under-reporting of income for that person. The fourth subclass under this subsection 2 tells us about deemed income. What is when the deemed income is determined? Deemed income is determined when the income is assessed under section 115 JB or 115 JC. Under section 115 JB, under MAT, minimum alternative tax or alternate minimum tax is assessed. And whenever these are the cases, then when the deemed income is assessed and which is greater than the deemed total income determined under section 143(1). But I would like to mention here, this is the circumstances where the return of income has been filed, because the income determined should be there, and it is mandatory for the department to pass order under section 143(1)(a), because under-reporting income can be determined only when there is a difference between the two of deemed assessed income or deemed total income determined under section 143(1)(a). In case the income is not determined under section 143(1)(a), then the department cannot determine the under-reporting of income, because no order under section 143(1)(a) is passed. So it has become mandatory from the assessment year 2017-18 to pass order under section 143(1)(a), where the return of income is furnished by the assessee. The next subclass is about the deemed total income is greater than the maximum amount not chargeable tax when no return of income is filed, or return of income is filed in response to notice under section 148, and in that case the difference between the two, that is deemed total income or reassessed income, shall be the under-reporting income for that person. And the last subclass tells us about, under this section, subsection 2, deemed total income reassessed is greater than the deemed total last assessed income or reassessed income in the preceding order. I have forgot to mention the word preceding order in the case where the difference between the two has to be taken from the return furnished or return assessed at the time of reassessment or income assessed. So you have to take the difference between the deemed total income reassessed and deemed total income last assessed or reassessed. The third subsection, quite important, it tells us about the under-reporting of income. What is under-reporting of income? It starts with whenever the income has been assessed for the first time. Whenever the income has been assessed for the first time. And you can see from the PowerPoint presentation also, yes, on the screen you are watching that it is about the computation of under-reporting of income. This subsection only tells about what is under-reporting of income, and this section starts with where the income has been assessed for the first time. If the return of income has been furnished, the difference between the assessed income and the income determined under section 143(1)(a) shall be the under-reporting of income. Now you can focusing on that what is under-reporting of income. It is most important. I am again saying that, reiterating that it is most important to know that what is under-reporting of income. Unless you are aware of the what is under-reporting of income, you cannot impose the penalty about under this section. So it is quite important to know what is under-reporting of income. I am again starting with where the first time assessment is being made and the return has been furnished. In that case, the difference between the income assessed and the income determined under section 143(1)(a) shall be the under-reporting of income. And let us take an example again so that it will be easier or for you to understand it. If the income assessed, as I have already mentioned that, if the income assessed is 10 lakhs and the income determined under section 143(1)(a) is 8 lakhs. Now, the difference between the two, that is 2 lakhs, it will be under-reporting of income. On that amount, the penalty shall be imposed. We will discuss later in the part what amount of penalty, at what percentage the penalty is to be imposed. First, we will learn that what is under-reporting of income. Most importantly, now second in this category, in this subsection, where the assessee has not furnished the return of income or assessee has furnished the return of income in response to notice under section 148. In that case, what happened? In the case of company, firm or local authority, the assessed income shall be the under-reporting of income because there is no slab in that income and the tax start charging on that section from the rupee 1. If the, let us take an example, in the case of company, corporate, the assessed income is 1 lakh and the rate of tax in the case of company for domestic companies is 30%. In that case, the 30% charge on the 1 lakh rupees, that will be 30,000. And apart that, there may be cases of cess also there and surcharge also. But surcharge is charged under different circumstances. I will also explain it in a later part. But now the most important thing is on what income, what is the under-reporting of income? And under-reporting of income in the case of company, in the case of firm, in the case of local authority is the assessed income where the assessee has failed to file the return of income or filed the return of income first time under section 148 of the Act. Next is where the, in this subsection, next clause is about, tells us that where the income is assessed, reassessed or recomputed and the which is greater than the income assessed, reassessed or recomputed in the preceding order is the under-reporting of income. So let us take an example about this. If the income reassessed is 20 lakhs and income assessed in the preceding order, that is for the same assessment year, if any order is passed, let us assume that original order is passed under section 143(3) and the income assessed is 10 lakhs. Case is reopened and the income was reassessed and the reassessed income is 20 lakhs, but in the same assessment year the original income was assessed at rupees 10 lakhs. The difference between the two is 10 lakhs. that is underreporting of income, on which tax will be computed and the penalty shall be imposed. Moreover, this subsection also explain about the deemed total income. When the underreporting of income, the case of deemed total income, it elucidates, explain the formula. It tells us in a formula for determining the underreporting of income. Formula is A minus B plus C minus D. And what is A? What is B? What is C? Or what is D? A. A is the first we will determine that income as per the normal provision. As per the normal provisions. And B shall be the income assessed as per the normal provision minus underreporting of income. That amount shall be reduced from the A part, that is income assessed as per the normal provision. A minus B. Again I am saying that A is the income assessed as per the normal provision. B is the income assessed reduced by underreporting of income, A minus B. Now plus we will add the income of deemed total income, that is mentioned in part C or D. What is C? C is the deemed income assessed under section 115 JB or section 115 JC. And what is D? D is income assessed under section 115 JB or JC minus or reduced by underreporting of income. When both these categories are aggregated, then the income shall be underreporting of income where the deemed total income is there. Where the deemed total income is there. Let us take another example. If the income assessed as per the normal provision is 10 lakh and the underreporting of income is 2 lakh, and then we will first take up 10 lakhs minus 8 lakhs, and after that whatever will be the amount, that will be the underreporting of income. And where the deemed total income is there, then we will just I have explained that C or D part. C part explain about the deemed total income assessed, and D part explain about the deemed total income reduced by the underreporting of income. When we aggregate, when we total, when we add these amounts, then the total amount will be the underreporting of income. So I have explained the subsection 3 also. I just wanted to close this class at this point of view, because I have in this class I have mentioned that what is underreporting of income, under what circumstances penalty is to be imposed, and other things also. Because the class is very lengthy and there are another subsections also, and in the next class we will take up subsection 4 of section 270 capital A and till subsection 12. So it will be easier for you to understand the provisions, otherwise it will be quite difficult or cumbersome for you to understand. Thank you, and if you like this my class, kindly like it, share it or subscribe it, so that it will motivate me, so that I could take up another classes about the income tax. I will be again in touch with you. Thank you again.